Every mighty nation vows that its currency is completely safe. Every political power insists its written guarantees will stand the test of time. And every single time, the detailed record of history proves all of them totally wrong, from the height of the Roman Empire to revolutionary France, from the Confederate States to modern-day Lebanon. Ordinary people have suddenly awakened to discover their entire life savings are worthless. Their monthly paychecks mean absolutely nothing, and their future security has been completely wiped out by financial systems they believed were indestructible. A total breakdown isn't a rare thing. Collapse is the normal outcome. The real critical question isn't whether our current financial structures will eventually fail. It is how you will ensure your own safety when they definitely do. This dangerous fantasy of money lasting forever is the single most costly financial error any person can make. We check the figures in our bank accounts. We see our national paper money, and we simply assume they are solid rock. But money is not solid rock. It is merely a shared belief. And that belief can vanish in a single night. That's precisely why history can be so brutal, and yet so incredibly helpful. Every major collapse leaves behind a clear trail of important lessons, recurring behaviors, and loud warnings about what actually preserves wealth and what simply turns to dust. And if you watch closely, you will see that the people who successfully emerged from these disasters were not the ones who believed the system the most. They were the ones who were doubtful from the start. Look at the Byzantine Empire, often remembered as the eastern half of the Roman world that somehow kept going for 1,000 years after the western side fell. At the very core of its robust economy was the gold solidus, a coin so reliable and pure that merchants across all of Europe, the Middle East, and Asia accepted it without any argument. For many centuries, it was the closest thing the medieval world had to a global currency everyone trusted. But here's the key point attentive people will grasp. You'd think they would have taken a lesson from Rome's earlier disaster with the silver denarius, where emperors kept reducing the silver content until it was practically tin with a thin silver coating. We have covered that story before. But no, centuries later, the Byzantines made the exact same error using gold. They began chipping away at its purity, stretching the gold thinner and thinner, mixing in much cheaper metals. At first, nobody really noticed the difference. Then, the collective confidence cracked wide open. The coin that had once securely anchored all Mediterranean trade suddenly became just another piece of political fiction. This endless weakening destroyed its reliability. And with it, the entire Byzantine economy lost the amazing stability it had once enjoyed. What truly lasted through that crisis? Not the government's paper promises. Not the emperor's official orders. Merchants who had intelligently kept stashes of real physical gold or purchased secure land outside the empire's immediate control preserved their wealth while everyone else watched their money dissolve. That is the first unbreakable lesson. Governments cannot resist the urgent desire to cheapen their own money supply. And when they inevitably do, real value quickly moves to physical assets they cannot simply print more of. But not every complete failure comes from rulers secretly playing games with coins. Sometimes, it is caused by sudden, violent shocks that hit completely out of the blue. In the middle of the 14th century, Europe was hit by the most lethal pandemic in its recorded history, the terrible Black Death. Between the years 1347 and 1351, up to half of all Europeans lost their lives. Great cities became ghostly quiet. Small villages completely vanished, and crucial trade routes shut down. And yet, the economic impact of the plague is much more complicated than simply a total catastrophe. This is because when half the entire workforce disappears, the labor that remains suddenly becomes immensely valuable. The people who survived could demand significantly higher pay. Food and land, previously hard to find, became relatively plentiful compared to the number of people left alive. Families who possessed liquidity, actual silver coins, trade goods, or even just the physical ability to work, suddenly held bargaining power they had never even imagined. Land that had once cost a huge fortune could be bought for a tiny fraction of the price. Houses stood empty. Fields were left unplowed. And the survivors found themselves in a buyer's marketplace. If that situation feels too familiar today, it absolutely should. During the COVID-19 pandemic, we witnessed a very modern version of this same thing. Supply chains were badly broken. Governments printed trillions of dollars just to keep the entire machine from stopping. And a huge wave of economic inequality followed as those with available cash bought up assets, while people living paycheck to paycheck fell further into debt. In the United States, Average housing prices jumped high. Stock markets recovered almost instantly, while millions of everyday citizens desperately struggled to pay their rent. The historical pattern is clear. Pandemics dramatically rearrange wealth. They always have. The survivors of the Black Death used the sudden labor shortage to move up the social ladder. The survivors of COVID-19, with available funds, quickly scooped up houses, stocks, and small businesses that other people could no longer afford to keep. The resulting lesson is a tough one. But it is true. Crises financially reward those who have reserves and harshly punish those who don't have any. And while pandemics teach us how quickly external shocks can flip an economy upside down, the famous banking collapse in Renaissance Florence shows us another equally important truth. Huge institutions that appear too secure to fail can be toppled like stacked toy blocks. In the 1340s, Florence was the undisputed finance hub of Europe, home to powerful banking dynasties like the Bardi and Peruzzi families. These massive banks had made huge loans to European kings, most disastrously to King Edward III of England, who then simply stopped paying back those enormous debts during his ongoing wars with France. When Edward stopped the payments, the powerful banks completely failed. Depositors instantly lost everything. Trade across the continent froze up. Florence, once incredibly rich and powerful, was thrown into total chaos. The average person who had placed their trust in the city's mighty banking families discovered that large size did not equal safety, and a great reputation provided no real security. What essential truth did the people learn? That the phrase, "too big to fail," is a dangerous lie as old as the concept of lending money itself. Institutions exist primarily to make money, not to ensure your personal survival. When they collapse, they will gladly take your savings down with them. This harsh lesson has been repeated in every century, from the Florentine disaster to Lehman Brothers in 2008, to the banks of Lebanon completely freezing accounts in 2019. Survival belongs to the individuals who correctly understand that a bank's promises are only valid until the moment they are broken. The American Civil War is best known for its many battles, its key political moves, and the eventual end of slavery. But hidden behind all the fighting and speeches was a vicious financial conflict that most Americans today barely understand. The Union and the Confederacy both quickly realized that fighting a war of that size required them to print vast sums of money. In the North, the government issued greenbacks, paper currency that was not backed by physical gold but by the simple promise of the United States itself. At first, this bold move felt patriotic and necessary, but the more greenbacks that poured into the economy, the less purchasing power each dollar had. Inflation rapidly ate away at their value, and public faith in the money began to shake. In the South, the financial problem was far worse. The Confederacy, completely desperate for any resource, printed graybacks in absolutely shocking amounts. By the very end of the war, Confederate inflation had reached levels that are almost impossible to imagine. Prices went up by thousands of %. And a soldier's pay could buy almost nothing. A soldier's paycheck was basically worthless before he even had a chance to spend it. Families were seen carrying bulky bundles of bills that could barely buy a single loaf of bread. By the year 1865, the Confederate currency was not just weak, it was totally dead. What mattered most during that complete collapse was not any official paper promises, but hard, physical assets, land, food supplies, gold. Anything real and tangible held its value perfectly, while the paper money became a terrible joke. For ordinary Southern families, this was heartbreaking. Their entire life savings vanished into nothing. For shrewd people who had access to real, physical goods, the war was a chance to quickly grab property and wealth at incredibly low prices. This is a very important lesson Americans rarely hear, but one they should never forget. Your own country has already experienced a total currency collapse, and when it happened, personal safety came not from trusting the paper in your wallet, but from holding real value the government system could not simply inflate away. France, too, provides a terrible example of how political revolutions can completely destroy a currency faster than any conflict. In the 1790s, as revolutionary forces overthrew the king and took control of church lands, they issued a new paper currency, the assignats, backed, in theory, by the value of the recently seized property. These notes were supposed to bring stability back to the economy. Instead, the government printed them with reckless abandon. Every new batch printed made the last batch worth less. Prices spun violently upward. Workers' wages failed to keep pace. and soon the assignat was completely worthless. Farmers everywhere refused to trade their food for paper, demanding actual goods or silver coins instead. In Paris, the famous bread riots returned, and the entire revolution began to eat itself alive. The winners in this financial ruin were not the people proudly holding the patriotic paper. They were the ones who held food, gold, or property, things the government was physically unable to print more of. For the everyday person in Paris, the lesson arrived far too late. Political promises, no matter how noble the goal, are only worth what other people are willing to trade you for them. When that basic trust finally breaks, your hard-earned savings don't just get smaller, they completely disappear. Move forward 2 centuries, and this exact same disaster appears again in Asia. In 1997, a simple bet against the Thai baht currency quickly ballooned into a massive regional financial crisis. Thailand had borrowed huge amounts of money in US dollars, confidently believing that its currency's fixed rate would never change. But when that rate collapsed, the debts denominated in foreign currency became instantly unpayable overnight. International investors panicked and fled. Currencies all across Southeast Asia, Indonesia, Malaysia, South Korea, collapsed in a devastating, rapid sequence. Entire economies shrank. Unemployment soared to huge levels, and governments were forced to beg the International Monetary Fund for emergency help. The people who suffered the most were not the wealthy global investors who started the panic. It was the ordinary citizens, whose savings instantly lost value, whose mortgage payments suddenly doubled, and whose jobs evaporated. And yet, the fundamental pattern was painfully familiar. Those individuals who held US dollars or assets located abroad survived much better than those who relied solely on their local currency. Nations that had huge foreign debts were forced into harsh cuts, while big Wall Street firms walked away with incredible fire sale deals on high-quality Asian assets. What seemed like a local currency failure was, in truth, a massive global movement of wealth. The lesson echoes every single collapse from ancient Byzantium to modern Argentina. Debt taken on in someone else's currency is a lethal trap. When the huge storm hits, it is never the lender who drowns. It is always the borrower. By now, the full picture should be painfully obvious. Whether you look at revolutionary France, Civil War America, or modern Asia, the same core ideas repeat. Paper money eventually collapses. Debt creates chains for nations and ordinary families, and the people who successfully survive are never the ones who blindly trust the system the most, but the ones who recognize its true weakness before it completely shatters. The most disturbing part of history is that this type of financial collapse is not just a problem from the past or a distant place. It's happening right now. In Lebanon between 2019 and 2021, the entire banking system did something that still seems impossible to most people in the modern world. They suddenly locked the doors. Citizens woke up to find their savings completely frozen, cash withdrawals severely limited, and their national currency rapidly failing. The Lebanese pound ultimately lost over 90% of its full value. A person's entire life savings quickly became worthless pocket change. People stood in long lines outside banks, desperately pleading for access to their own cash, only to be told the money was simply gone. And this disaster didn't just affect a few small savers. Middle-class families, retirees, doctors, and engineers, everyone who had simply trusted the established system, were financially wiped out. The lesson they learned was harsh and completely clear. The money you put in a bank is not a protected treasure chest. It is essentially a loan you have given to an institution that can choose, in a time of crisis, not to pay you back. The people who survived this recent tragedy best were those who had either spread their money overseas, held tangible assets like gold or property, or kept a significant amount of cash completely outside the official banking structure. Everyone else was left completely trapped. If this still feels far away, it shouldn't. In 2008, Americans watched as their homes were taken away, and their retirement funds were badly damaged, while the huge banks that created the crisis were rescued with taxpayer money. In 2020, during the pandemic, trillions of dollars were printed to keep the entire financial machine operating, a temporary fix that increased the price of assets for the wealthy while leaving the average person's wages stuck in place. In 2023, local regional banks in the United States completely failed almost overnight when their depositors panicked and pulled their funds, reminding everyone that the claimed safety of too big to fail is just a comforting story we tell ourselves until the moment the door slams shut. So what is the most important thing you can do to protect yourself when everything starts to fall apart? History shows there is no single, easy answer. In Byzantium, it was holding gold. After the Black Death, it was having cash to buy abandoned land. In Florence, it was the wisdom of not trusting the megabankers. In the Confederacy, it was having real, essential goods. In France, it was food and property. In Asia, it was avoiding debt in a foreign currency. In Lebanon, it was getting all your money out of the banks before they abruptly closed. The specific circumstances change, but the core lesson is always the same. Survival does not come from a blind, hopeful belief in paper money or huge institutions, but from correctly knowing what holds real, lasting value when all the fake illusions break down. And here is the crucial idea that should truly motivate you. A financial collapse is both a terrible event and a huge opportunity. For the person who is completely unprepared, it means total ruin. But for those who have built in resilience, saved up liquidity, or acquired assets that cannot be printed into existence, it is the absolute perfect moment to acquire wealth at a tiny fraction of its previous cost. After the Black Death, regular peasants became landowners because there was too much land available and not enough people to work it. After 2008, those with cash bought houses and investments while millions were forced out of their homes. History teaches us that protection is not only about defense. It is also about positioning yourself strategically to take control of what others, under extreme pressure, are forced to abandon. But true lasting wealth isn't just about the physical things you own. It is also deeply tied to what you can actually do. The people who survived historical collapses were not just those who had gold or property. They were the key individuals who could create immediate value when everyone else was helpless. The baker who could still produce fresh bread. The skilled craftsman who could fix vital tools. The farmer who could feed his local community. The merchant who could still move essential goods across borders. These were the people who did not just survive these terrible breakdowns. They actually climbed higher because of them. In every single crisis, money quickly loses its meaning. But basic production never does. People will always need to eat, to build, to trade, to simply live their lives. And those who can meet those essential needs are never poor for long. That is the deeper, ultimate kind of protection, not a naive, hopeful faith in official institutions, not the wish that governments or banks will step in to save you, but the essential combination of real assets, practical skills, and the clear understanding that all illusions eventually and inevitably collapse. Every crisis is simply a major transfer of wealth. It moves from the many people who trusted, to the small, prepared group who wisely doubted. It moves from flimsy paper promises, to solid, tangible value. It shifts from passive, hopeful savers, to active, resourceful builders. History has shown this exact pattern again and again. So the real question is not whether the entire system will eventually fall apart. It always will. The question is whether you will be one of the many left holding worthless promises, or one of the few holding on to something truly real. History doesn't exactly repeat its lessons, but if you choose to ignore its strong warnings, it will surely crush you all the same. If this view has given you a different perspective, please make sure to subscribe. History holds all the answers we need, and I will keep showing you exactly where to find them.